Okay, hello, everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to have a quick review about why interest rates are lower in loans than in lines of credit, right? And I have two mortgages right now, both under 10%, right? One is 8% investment mortgage. Another one is my personal residence at 2.875. And then I have over $240,000 in lines of credit. I can't even believe I'm saying that. If you talked to me like 5 years ago and I was like, I have like 10, if I had $10,000 in lines of credit, I'd be like mind blown. And now I like 240 and I'm acting like that's not enough. Isn't that crazy? But I have over $240,000 in lines of credit. And you notice a few patterns, like a personal line of credit on average, and the interest rates change, but on average is like 15%. Home equity is around 10%, and then credit cards can go from like 17 to 30%. And what does that all mean? Is why is it that the lines of credit have higher interest rates than the loans? And is it a bad thing? And should we only be using low interest rate loans, right? You'll never hear in this channel, oh, loans bad, lines of credit good. Replace your mortgage with a line of credit just because line of credit, right? They're all tools. So, for example, let's say like I'm going to buy $1 million apartment building or something or multifamily, and someone offered me like a really low interest rate loan at like 1% for like $1 million for the entirety. I take it, right? And then I try to get a line of credit because again, they're all tools that are appropriate at the right time. Now, the way that I think of interest, and this is actually how I was taught, I didn't come up with this, is that interest represents two things: the amount of access you have to money and the higher the risk, right? So think about it like if you were the bank and you're designing different lending products, right? And again, you don't have to reinvent the wheel, but let's say like loans and lines of credit never existed, or amortized loans. So if you want people to borrow money and still make it attractive for them and still make profit out of it, well, maybe you cut their access and thus you charge a lower interest rate, right? So, for example, if I have an amortized loan or a student loan, auto loan, mortgage, um, the way that I kind of think about it is almost like a minimum payment. Like a kind of like, let's say you had like a credit card, but it was like a minimum payment that if you went over that minimum payment, you can really never access your money, right? So it's a one-way street. That's how I think of a monthly payment of a loan. Like it's a minimum payment that if you ever decide to pay more than a minimum, you never have direct access to the money. Okay. Whereas, lines of credit, the only real difference between that and lines of credit is that, you don't have the fixed payment over time, but also you have a two-way street, meaning that you can pay money, take it back, and use it over and over again. And thus, in that scenario where you have access to more features, and this is true of any product, the more features you get access to, the more you have to pay. We're going to charge you a higher interest rate, right? So with the loan, it's just a one-way street. You pay that fixed payment over time, and they're expecting that you're not going to ever go, or as a general rule, go over that monthly payment, because if you do, they're not going to make as much money with that low interest rate. And the only way that anybody can make money with low interest rates is just extend that sucker or extend that loan for a long period of time, which is how 30-year mortgages work, right? So, if you ever looked at the amount of money made in a 30-year mortgage, yeah, the interest rates are lower than the line of credit, but because the length of the period is so long, and if you ever seen that insane formula that I could never memorize off the top of my head to figure out the monthly payment, um, you'll realize like how they can make so much money, because that monthly payment is so low, and you're never incentivized as a general rule to make more, or I'm sorry, pay more than that monthly payment, because you have less access to your money, right? Another way that you can think of interest is a rating of risk, right? So if you're like a deadbeat, right, and I don't, that's the word that I just came up with right now. I couldn't think of anything else. But let's say you've been pretty bad at paying your bills, then that's going to pretty much appear on your credit report, right? Like you don't pay a credit card more than 90 days, then, creditors, if they're going to decide to, give you a loan or a line of credit, they're going to charge you more money because you're higher risk, right? And so, what is one of the ways that we can kind of lower that risk is one, have a good credit profile. So, make sure that we pay all of our bills on time, that we keep our promises to our lenders. But the other thing that we can do to lower our risk is offer collateral, right? So, with a home equity line of credit, the reason why it's a lower interest rate than, let's say, your personal line of credit is because you're offering your home equity as collateral. And if you ever take a business credit course, which I haven't used all the things discussed in it, but one of the things that's really emphasized is that there's many different types of financing that you can offer as collateral. You can even offer uh, your business's revenue as collateral, right? So it doesn't have to be an actual object or like your home as collateral, but it's one of the ways that you can lower the lender's risk to offer collateral in case you don't pay the lender, right? And so that's kind of what the way that I actually was taught, and I think it's really insightful to think about interest. They charge you more money essentially for more features, and they'll also charge you less money on the other hand if you're not as much of a risk. Okay, and so um, I know there are people out there who just say, "Oh my goodness, loans have lower interest rates, therefore better than lines of credit," or and vice versa, right? Um, Both are good, right? Both have their own uses at the appropriate times, and I have two loans, I have two mortgages, right? But I know that if I doing what I'm doing, I'm able to kind of wipe out those suckers out in which should be in a few years, and I should be okay, and I'll have like a ton of equity that I can use for, I don't know, the next deal or something, right? But what I'm saying is that if I didn't understand how these products work, kind of like the ins and outs, I would just probably be like your average American who just thinks solely on two things: that low interest rate number, and I probably refinance too, right? So the low interest rate number, the low monthly payment, and I don't think about the total interest and the length of time, how that affects the amount I'm paying to the lender. Okay. And this is why so many people don't pay off a 30-year mortgage in 30 years, because they're looking at those two things, which is the low monthly payment, the low interest rate, and they don't consider time to be a factor, because they expect to be the bank to be their landlord for the rest of their lives, right? But again, these are all tools. You just have to understand what the tools are for. So there will be certain moments in my life where I find it more appropriate to use a higher interest line of credit than a loan, or I might take out a loan and still use a higher interest line of credit at the same time. But one thing I certainly don't want to do is pay a 30-year mortgage in 30 years, or probably more, because my understanding is that the average American takes like 52 years to pay off a mortgages with refinances. But in general, like I don't want to pay 50%, 100% interest as a whole over 30 years, just because I didn't understand that the low number of the interest rate and the low monthly payment, I didn't understand how they added up over time. Okay. All right. So this is Korean Atlanta Mentorship. So it's just a quick review of what interest is and what it represents. Again, in the way that I was taught when I first took velocity banking was that interest is just represents two things: access to money and how much of a risk you are to the lender. Okay. All right. So that's it for today. If you're interested in joining our group, go ahead and click the Google form link below. Other than that, have a great day, and we will speak soon.